Hi and welcome to today's video. So we're going to do something a little bit different. We're going to do some financial maths revision, but this is a special COVID-19 edition. So specifically looking about what's going on in the world right now and how that might impact on specifically a mortgage payment. So we're going to do a case study. So this is Mary. So Mary's been affected by the current COVID-19 restrictions in place. She is now relying on the weekly COVID-19 payment of €350 per week. In 2016, Mary purchased her home using a mortgage of $250,000 from AIB, which he started repaying in February 2016. Her monthly repayments are €990.49. The original term of her mortgage was 30 years and she has a fixed interest rate of 2.55% APR. So Mary's heard about a mortgage break that are being given by banks during this time, and wants to investigate this further because at the moment she's only left with 100 per week to cover all of her other expenses after making that mortgage payment. So this is got to do with what a lot of people are facing right now. Incomes have been reduced. On the foot of that, banks are now offering this idea of a mortgage break, so to take a break from your payments. So she Googles these mortgage breaks to find out more, and this is the information that she finds on the AIB website. So we've a range of short and long-term solutions to back our customers in financial difficulty because of COVID-19. Short-term COVID-19 3-month payment breaks or pay interest only breaks are available. So what does that mean? So Mary's never heard of this idea of pay interest only breaks, so she did a little bit more research to try find out what is the most feasible option for her. So a payment break. So what is a mortgage payment break? So in these tough times, we're offering mortgage customers who have been affected by COVID-19 a 3-month payment break or interest only payment break. And it gives the flexibility to take a break from paying your mortgage repayments for up to 3 months. So what's the difference between a payment break and an interest-only payment break? So it says a complete break means you will not have to make any mortgage repayments for up to 3 months, and an interest-only payment breaks means you only pay the interest on your mortgage for up to 3 months. During this time, you do not pay any of the mortgage balance. So now that Mary understands a bit more about each option, she wonders which one she should choose. So she speaks to a friend who works in finance, and she advised Mary to look at the short and long-term costs of both options. Unfortunately, Mary did not learn this in school like you guys, so she has come to you to ask for help. And there is a bit of information on the website, but that information is quite standard and she's not sure if it will reflect her own situation. So we need to do a bit of calculation. So we're going to do, like I said, a revision really of mortgages under financial maths using Mary. So what was the original cost of her mortgage? So I've just pulled up the details again. So in 2016, Mary purchased her home using a mortgage. She started repaying in February 2016. Her monthly repayment is that, and the original term was 30 years, and she had a fixed interest rate of 2.55%. APR, so annual percentage rate. So what that means is we're going to have to figure out, well, how much is the actual monthly rate? So we're going to get a monthly repayment, but before we can do a monthly repayment, we're going to get a monthly interest rate. So we're going to use the idea that if I invest something for 12 months at a monthly interest rate, it'll be the same as if I invest something for 1 year at the yearly or annual interest rate. So that is 1 plus or to the power of 12, where or is the monthly interest rate, and that is equal to 1 plus I, which is the annual interest rate, which is 2.55%, but that always goes in decimal form. So we get 1 plus or is equal to the 12th root of 1.0255, and then I'm too lazy to write out that as a decimal, so I'll leave it under the 12th root minus 1, and my final answer is 0.210056%. So I'm leaving it quite long to try to keep it as accurate as possible. Um, Obviously, all the calculations that are being done in banks and all right now are happening on a computer, so they can be super duper accurate. But we're going to stay here, okay? So then, second thing we're going to do is we're going to go to page 31 of our log tables and take the amortization formula. So that amortization formula helps us to calculate the equal repayments. So we're going to say that our initial principal, P, is 250,000. That's the amount of the loan. My interest rate, remember it's monthly, so 0.00210056. And we have 30 years, so that's 360 months. So filling that into our formula here, that's what it looks like, and just sticking that whole thing into the calculator, it ends up as 990 and 49 cents, which is what we were told up here. So that is just a little bit of revision how we can figure out the monthly repayments if we have any kind of loan or mortgage. Remember that a mortgage is a specific loan on a building. So most people take these loans out at quite a low interest rate, but for quite a long time. Okay, so the longer the term, the lower our interest rate tends to be. So then that's our monthly interest, no, that's our monthly repayment. So not that I suppose we needed to verify. We hope that she knows her own payments. But I suppose, like, if we think about 30 years, she has 360 payments to make. Every payment she makes costs her €990.49. So that means after the whole 30 years of the loan, she pays back €356,565.60. Now, that means the cost of the actual mortgage. So the cost to her over those 30 years is 565 euro and 60 cents. That is huge. And that is interest. This is the cost of money, the time value of money, because she has taken that money from the bank and invested it and put it into this house for so long. The bank is not getting it back, so they're charging her interest for the pleasure. However, that amount is huge. And really, to understand it, given how high the number is, let's see how it works out in terms as a percentage. So if I put that number over 250,000, which was the cost of, well, it was what the house actually cost, how much she actually borrowed, over the life of the mortgage, she pays back an extra 42.63%. That is crazy. So I suppose, like, this is where you kind of need to think, like, are you surprised by this? Does this shock you or surprise you? And would you have taken out this mortgage? And I suppose if you're looking at this and you're kind of 17, 18, 19, you're probably thinking, oh my God, that's absolute madness. But yet, people in Ireland, everywhere, most of them, mortgage. So why are people paying this huge sum of money? And, like, is there an alternative? Well, let's check back in with Mary and see, was she aware of this? Because I suppose this is the question. Do you think that a lot of people truly understand the full cost of a mortgage? Do you think that people go into it going, oh yeah, I'm going to have to pay an extra 42%? Or do you think that they just don't even think about that side of it? So let's check in with Mary and see what she said. So here's our little memo back to Mary. For attention of Mary, over the course of your 30-year mortgage, you will be paying back an extra this much, and that is an extra so much in interest. Okay, so over 100,000 and nearly 43%, well, 42% in interest. So what does Mary have to say about this? So in reply, Mary confirms that she is aware of this. And here's the reasons that she is happy to pay it. Interesting. She has reasons. It works out at €300 per month over 30 years. So if the house was sold for the same amount, so if she sells it for 250,000 in 30 years, she will basically have paid €300 per month for rent, which is actually great value for the house where it's situated. Okay, so as renting go, and I suppose you could argue that current rents are much higher, and they may go even higher. So, okay, number one, she said, if I sell the house for what I bought it for, so made no money on it, if the price remains the same, this is where I'm at. But house prices were low when the house was purchased. So 2016, we're talking about coming out of the recession. House prices were still quite low and have climbed significantly. We're now 2020, so that's 4 years. So prices have seen an increase. So she says house prices were low when the house was purchased, and at the peak, houses like hers were selling for up to 450,000. Okay, so she got a good deal. And she says, well, if prices were to rise, then she could make a profit even after paying interest. That's basing on selling at that high point. And she says, well, if the house prices did rise, she would sell her current house for a profit, pay off her mortgage, and downsize, so go to a smaller, cheaper house. So we're kind of two situations. She's dealing with if the house prices appreciate, which means go up in value, and she said that if they stay the same. Notice she must be optimistic because she doesn't talk about what would happen if house prices go down. I suppose we have to trust that Mary was aware of the lowest price that the house has been, or houses similar. And we've seen like house prices seriously dip during the recession at the early 2010s, so maybe she's aware of that, or eternally optimistic. So let's get back to the actual. We got a little sidetracked with those big numbers. So we now know how much that original mortgage was going to cost Mary. What we want to understand then is how much will either of these new options, so either taking a 3-month break from payments completely, or instead taking a 3-month interest pay interest only break, how much will they cost? And then we can compare. But before we can do either of the options, we have to understand what has happened so far. So how much of the mortgage has been paid off? Now, I'm taking this as March 2020, which means if you're watching it any later than March, we've done the calculations for Mary in March. This case study happened in March 2020. So when you'd make a mortgage payment, a portion goes towards paying off the principal and a portion goes to paying off the interest. Okay. And the principal outstanding reduces, so as the principal outstanding reduces, so that's really the amount of the mortgage, the interest reduces, because if you owe less money, then the interest will obviously be lower. Okay, makes sense. And this means as time goes by, the portion of the payment going towards principal increases and the portion going towards interest decreases. Okay, so what does this mean? So I have a little diagram here. And what you can see is in this kind of reddy color, we have the interest payment, and the yellow color is principal. All the bars are the same because remember, this is amortized. There is a level payment. We're paying the same all the time. And as you can see at the start, the little bit of principal that's being just a little bit of principal is being paid off, and it gets bigger, bigger, bigger. And the opposite is happening for the interest. At the start, most of our payment is going in interest, and it goes down then to very little as time goes by. This is just a 30-year mortgage payment, 200,000, and that's a yearly. It's not exactly ours, but we will see Mary's as a graph in a second. So what we do to help us really understand this, it's called a schedule, and it helps us to split up the interest and the principal. So this is what it looks like, and we have seen this come up in an exam in exam questions. So we have all our payments here. I've just done 5 because remember we have 360 payments, and the payment amount is €990.49. So that remains the same. At the start of the loan, so before my payment number 1, I have an outstanding principal of 250,000. So that's how much is outstanding on the loan itself. My interest rate, remember it's monthly because my payments are monthly, is 0.210056%. And we want to figure out the interest portion and then the principal portion. So it's quite simple. The interest portion is simply the interest on the principal outstanding. So we do 0.210056% of 250,000. And that gives us €525.14. Whatever is then left over goes towards the principal. So to calculate the principal portion, we have 990.49 take away 525.14, which gives us 465.35. So what we should be able to see here is that those two numbers will always add up to our payment amount. So for example, if you add these and this, it will add to 990.49. So the breakdown, first of all, we'll deal with the interest, and then whatever's left over goes towards the principal. So basically, as that amount outstanding decreases, obviously the interest decreases. So now I've paid off part of my principals. That's the principal portion. So €465.35. So that means I now only have €249,534.65 left. But it is lower. So I do expect when I calculate my interest this time that it is lower than €525.14. And it is. Not by much, but nearly €1. We'll take it. So €524.16, and then take it away from our payment amount to find out how much is left for the principal. If that interest piece has gone down by nearly €1, principal portion should go up by nearly €1. Yeah, and it did. And we continue this on. So now we take away that principal portion from what was outstanding, and we end up with a lovely schedule like this. And you can see that the interest is going down little by little, and the principal piece is going up little by little, but they still will always add to that payment amount. So we're going to use this schedule to help us figure out how much the mortgage that Mary has paid off by March 2020. So using Excel, I love Excel because it does things like this. And when I say in seconds, I mean it took seconds. Poof, and this is what it looked like. So Excel is great because it does calculations very quickly, but not only that is you can copy the calculations down and you create a table like this for 360 payments so quickly. It also creates beautiful visual graph, which is here. So this is my version of the graph we saw before, specifically for Mary. So the payment, if you look up the top of the graph, it's just under thousands. That's €990.49. And you can see that the purple piece is the interest. Now, it looks kind of nearly level because we were kind of nearly 50-50 at the start, and you can then see that the interest portion goes right down until we're practically paying full principal. So this is just a nice visual version of it, and you can see my little numbers along the bottom telling us which payment. So we have this kind of curve. It's not a straight line. We do have this curve, and that's coming from the fact that it's compounded interest, so it's to a power. So linking kind of to our exponentials here. So anyway, I got distracted by Excel. But we want to figure out how much of our mortgage is being paid off, so I used my Excel spreadsheet to do it. So could you be asked something like this in an exam? Yeah, you could, but they'd probably give you the schedule similar to what I'm doing here, or at least give you part of the schedule to fill in and then go from there. So Mary made her last payment in March 2020, and that means she's paid 4 full years, because remember we started in February, and then there's 2 months in this year, so then we have 50 full payments. Okay, so she made payment number 50, so it's payment number 51, 52, and 53 that she wants to skip. So how much of her mortgage is being paid off at that point? So I've pulled from Excel this section here, and we can see that this is what is outstanding. So she made payment 50. So our last payment, the interest portion was €474.75, and the principal portion was $515.74. So what's outstanding on her mortgage is $225,493.81. So that's what's outstanding. That's the principal, or the amount of the mortgage that is outstanding. So when we look at these questions, that's going to be a key number for us. So she made the 50th payment, so this is how much that is outstanding. So let's take a look at option 1, a payment break. So Mary's going to miss the Mary's going to miss the 51st, 52nd, and 53rd payment. That means there are 307 payments left, okay, and the balance of this outstanding. However, we also have to take into account not only the balance, but also the fact that over these 3 months she's going to owe some interest. So let's figure out what the interest will do. So how much interest? So I'm not really focusing in on the interest. I really want to know, well, how much really is outstanding. So she's going to be in, we're going to use our little formula here, future value. So the amount that she's going to owe will be the amount she currently owes. So 225,493.81 times 1 plus the interest rate to the power of 3, because that's 3 months of it sitting there. Okay, they're giving you a payment break. They're not giving you a break on your interest. So we will actually have outstanding 226,917 and 79 cents. Okay. If that's what's outstanding, including the 3 months interest, and there's 307 payments left, what's Mary's new monthly payment? Let's take a look. Amortization formula that we had earlier. We have our principal is this amount that is outstanding. Our interest rate hasn't changed, and our number of payments, T, is 307. A will give us the monthly payment, and we fill in our formula. When we fill in our formula, we then put that into the calculator, and our answer is €1,003.66. So the impact that that has had on her payments is there's an increase of €13.17 per payment. And remember, that increase is for 307. So have a think now. What do you think the overall impact this will have? So now that we know the impact on the monthly payment, bear in mind that she has had a 3-month break. So she said 3 months of paying nothing. So that's like 3,990s. Even though now it's 13.17 per payment extra. So have a think before we actually do it, what does your logic tell you would happen? So let's look at what the total cost of this payment break in the mortgage will be. So we had 50 payments that she made of the original amounts. That's €990.49, and that gives us €49,524.50. And then we have a remaining 307 payments of €1,003.66, and that gives us €308,123.62. When you add those together, we get €357,648.12. Remembering that the original cost of the mortgage was this, so taking a payment break has added on an additional €1,082.52. Did you predict that? Did you think that a 3-month break in your mortgage would have that amount? So bear in mind that we're comparing the original cost to the total cost. So before you say, but sure, you didn't pay for those 3 months, we've taken that into account. Okay, we have taken that into account because those 3 months are included in the original cost. They're not included in the other numbers. But over the course of the whole mortgage, remember the term is still going to be that original 30 years. It's still going to end on the day that it planned to end. We now have to pay an extra €1,000.82. There's €1,082.52. And then we're going to look at the second option. So our interest only payment. So again, we need to understand our payment schedule, but we're going to understand it a little bit differently. So we've stopped at 50 here. And I'm actually going to use the schedule because what the interest only means is I'm going to come along on payment 50 and I will make a payment, but it won't be of my mortgage or the principal piece. It will only be the interest piece. So payment 50 is normal, but for 51, 52, and 53, she's only paying interest. So I work out the interest for payment number 51. And there is no principal portion. So that payment amount is significantly reduced from €990.49 to €473.66. So it has over halved, yeah? So I'm now paying less than half of what I had originally, or what I was originally paying for my mortgage. So although it's not a full break, it is giving a little bit of a break. Now, because I don't pay any principal, the principal outstanding will actually be the same. So then the interest is the same. I don't pay principal. Payment amount is the same. And again, I'm not paying principal, so the principal outstanding is the same. Then my interest portion is the same. no principal portion, and again, same payment amount. Now, still not very exciting because my principal outstanding here is the same. My interest is the same. However, payment number 54, I'm back to normal. So I need to pay a principal portion as well. Remember how we worked out that principal portion though? What we did was we said, how much is my payment amount? Take away the interest portion and that pays my principal portion. But the problem is, I can't work out my principal portion because I don't know the payment amount. You might say, well, look, is it the same payment amount? And actually, remember, those payment amounts were to make sure we finished at the end of 30 years. We finished our payments. We won't be able to pay everything off if we keep using that 990.49 because of that 3-month break. So now we need to understand how much our monthly payment is going to be given our new amount outstanding as we begin at payment number 54. So now there's a new balance of 225,493.81 and we must pay that over 307 payments. So let's work out the new payment amount. Again, this amortization formula coming up again and again. It's a nice formula. We have our P, we have our I, we have our T. We fill into our formula and we get 997 and 36 cents. So that is an increase in payment of 687 per payment. Again, taking into account that, okay, we've still had to do some kind of payment in those 3 months of the break because it wasn't a proper break, but that is our increase. So let's see what the impact is. So the total cost, we had our 50 payments, just like in option 1. Those 50 payments are done. They're gone. There's nothing that can change. We're now going to have 3 months at our lower interest only payment. And then we have 307 payments at this new increased amount, which is 997.36, which is this number here. And we can add them together. So then, remember the original cost was this. So this is going to cost us an additional €587 and 40 cents. Okay, so let's summarize our two options and see what advice we could give. So payment break, we have 3 months of no payments. We have an increase of $13.17 per payment and a total increase in the cost of the mortgage by $1,082.52. That works out as a new percentage of 43.06, so slightly up from what we had because ours was 42 something percent at the beginning. If we pick a pay-only interest break, we have 3 months of reduced payments. So we pay $473.66. That's a reduction of $516.83. An increase of $687 per payment, and a total increase in the cost of the mortgage by $587.40. So that is slightly up on our 42 point whatever percent we had at the start, but it's not as high as the payment break. So I suppose, what advice would you give? Would you tell Mary to not take a payment break and just suck it up? Would you say do just a payment break? Would you do an interest only payment break? What do you think? This would be, I suppose, where you need to have more information about her and her lifestyle and what she needs money for and so on. Most people would probably think, well, look, yes, there has been, an increase to the total cost of mortgage, but because that is such a small increase per payment, so my monthly change is so minimal, I probably wouldn't even notice it. See what you think. I'd be delighted to hear some of your feedback. It's a pity that this has been done over video and not live, so we could have a discussion about it. I find all this stuff really, really interesting. You may not. At some point in your life, it may start becoming interesting. Most people will have a mortgage or loan of some type. They're offering similar breaks on just personal loans as well. Obviously, this has quite a big impact because we're talking about such big numbers, but there will be a similar impact for people taking payment breaks on any of their personal loans. I just taken this as an example with interest rates. Obviously, everybody has a different mortgage amount. Some people have variable interest and so on. But love to hear your thoughts. You can message me. You can leave it in the comments below. I don't mind. Um, and just hopefully start thinking about what's going on in the world now in terms of our maths course. So actually, we're quite relevant in what we do. So when you ask, when will I ever use this? Here you go. We've just solved Mary's problem.